life insurance. So now you're in the working world and have a family or thinking about having a family. You begin to wonder how you can take care of them if something were ever to happen to you. Well, you may want to invest in some life insurance. With that said, let's dive into the details about life insurance so you can get an understanding of it. Let me point out before you go to insurance shopping, your employer may offer a life insurance policy as an employee benefit. It might be a flat dollar figure such as $50,000, or it might be a multiple of your salary, say $250,000 policy for someone that makes $100,000 at 2.5 times your salary. Therefore, check to see if your employer offers this, and if so, check to see if it's enough coverage. If not, you then need to get an additional policy. Now onto the policies. First, there are two categories of life insurance, permanent and non-permanent. Permanent life insurance provides lifelong coverage as long as you pay the premiums. No matter when you die, your beneficiary will receive the death benefit you pay out. Permanent life insurance is often selected at an early age with the intent of covering final expenses and leaving an inheritance to a loved one. Many people choose permanent life insurance to ensure that their funeral costs are covered, as well as to gain more financial flexibility through the added cash value benefit. Non-permanent policies do not provide lifelong coverage. They are set for specific periods of time. So what are the types of policies? Number one, term life insurance, which is a non-permanent and is generally more affordable than permanent life insurance. It is going to give you coverage for a set number of years, paying out as long as your policy hasn't expired and you've paid the premiums. You can lock in your rate for the entire term, which makes budgeting and planning easier. Term policies generally cost less than permanent policies because they're only in place for a limited time. However, at the end of the term period, you may be able to renew your policy at an adjusted rate, and you can typically only renew a term policy on a year-to-year basis, not for another term period. Your new rate will be based on your age and health at the time of renewal, and you may need a medical exam to obtain coverage. The benefit of a life term policy is that it will ensure your family will have enough money to cover large expenses such as a mortgage or a child's tuition if you were to die unexpectedly. For example, you could take out a 20-year term life policy while your kids are young, giving your family financial security until the kids grow up and move out of the house. In certain situations, you may be able to convert a term life policy to a permanent life policy. So the number two policy I want to talk about is whole life insurance, which is a permanent policy that provides lifetime coverage, paying your benefit no matter when you pass, as long as you keep paying your premiums. Whole life insurance offers set premium rates and lasts for your entire life, so you won't have to worry about higher policy rates down the road. In addition, whole life insurance also includes a savings component that a portion of your premium will pay into. The savings component has a fixed interest rate that builds cash value over time, which is part of the reason whole life policies typically cost more than term life policies with similar coverage. In addition, the cash value of your whole life policy does not affect the death benefit paid upon your passing. However, if the cash value grows to equal your death benefit amount by the time you're a set age, say 100, your insurance will terminate your policy and pay out the coverage amount. Your cash value offers another benefit where you can choose to withdraw a portion of the funds as a loan based on your policy's cash value. There's typically no credit check required and a minimal loan approval process since you're essentially borrowing money from yourself. You can pay back the loan with interest, or if you pass away before returning the funds, the remaining loan amount and interest will be withdrawn from the payout of your beneficiaries. The third type of policy I want to talk about is a universal life insurance policy. This is another permanent life insurance option. And just like the whole life, it provides coverage for your entire life as long as the premiums are paid. It's sometimes called an adjustable life insurance because it offers more flexibility than a whole life policy. For example, universal life policies allow you to increase or decrease your death benefit and even adjust or skip your monthly premium within certain limits. In a similar fashion to whole life policy, a universal policy has a cash value component that also grows and allows for borrowing. However, a universal policy's cash value works a little differently than a whole policy's in two major ways. First, the interest rate for a universal policy's cash value is not fixed. You will have a guaranteed minimum interest rate, but in general, the rate at which your cash value builds can change over time based on market conditions. And second, your universal policy's cash value can eventually grow and result in a zero-cost policy, in which all premiums are paid from the cash value you've built. Number 4 is a variable life insurance policy, as this is a riskier type of permanent life insurance. A common variable life insurance policy is comprised of 2 pieces. First, a face value death benefit, which is a specific amount to be paid out upon your passing as long as you pay premiums. And the second is a variable cash value. Your cash value will rise and fall based on the payments you make and the performance of the investments you select. Unlike with whole and universal, your variable cash value can be part of your death benefit. A potential benefit or detriment to a variable policy is it has a greater range of investment options, which means it could provide a greater benefit to your beneficiaries when you pass away, but it also opens you up to a much higher risk, fees, costs than whole and universal policies have. And the last one I want to discuss is final expense insurance. This is a type of whole life insurance that offers a small and more affordable death benefit designed to help handle funeral costs, such as medical bills or outstanding credit card debt. While other types of life insurance may have age and health requirements, final expense policies can be easier for older or less healthy individuals to qualify for. A final expense policy's cash value would operate the same as whole life policies. In addition, final expense life insurance has 2 options: simplified issue and guaranteed issue. With guaranteed issue insurance, you don't have to answer any questions regarding your health. With both types, no medical exam is generally required. Here's a simplified table that compares the types of life insurance. And as I mentioned above, some policies have something called cash value. This is where you can build a kind of separate account within the policy. This is where your insurance provider sets aside a portion of your premiums into a separate account which can earn interest. You can use your cash value by borrowing against it, withdrawing some of it, or withdrawing it all at once and surrendering the policy. Understand that withdrawals over the amount of the premiums paid are usually taxable. Then there is a cash surrender value, which is when you cash out, you surrender the policy, which could result in surrender charges. The remaining balance, the cash value minus surrender charges, is your cash surrender value. Cash value and cash surrender value often differ due to fees, but they can be the same amount if you've held the product long enough. Now, if you're interested in a life insurance policy, it would be wise to talk to a professional advisor so you can make the best choice based upon your needs.